It's game over, Fed. This time, you've gone too far. I'm your host, Steve Van Metre, and thanks for joining me today. And there's internal strife at the Fed as board members are fearing that they've gone too far and the financial system is at risk of coming apart. Let's over to CNBC, where we picked today's story up with a headline: Fed officials see smaller rate hikes coming soon, as the minutes show. The Federal Reserve officials earlier this month agreed that smaller interest rate increases should happen soon as they evaluate the impact policy is having on the economy. Meeting released on Wednesday had to show. Now, there's something I want you to understand is these minutes that the Fed pushes out, they are actually changed from the actual meeting. If you go back to the FOMC press conference, what you'll notice that Powell was very sternly talking about there'll be more hikes and more hikes and more. And even during the press conference part where he was being interviewed, someone mentioned the stock market having a positive reaction by going up. And Powell just reiterated the hammer, we're coming, we're going to do even more, until the stock market actually reacted the other way. So when they use these minutes, they take that time between the press conference and the release of the minutes to gauge the sentiment and the reaction, and then they tweak them. So if you think these are the actual minutes from the meeting, well, they're not. They're actually tweaked a little bit to change the sentiment to make sure that everybody understands what the Fed really meant, not what they actually said. Reflecting statements that multiple officials have made over the past several weeks, the meeting summary pointed to smaller rate hikes coming. Market widely expected the rate-setting Federal Open Market Committee to step down to half a percentage point increase in December, following 4 straight 75 point percentage hikes. And so here we're seeing again that reaction of the Fed, that at the meeting Powell was insisting there's going to be more and more hikes, and all of a sudden the language got softer because Wall Street dialed their expectations down. And we know that the Fed does what Wall Street says, and so it all comes into alignment. The minutes need to reflect that the Fed is actually listening to what Wall Street is saying, and the hikes need to slow. Through hinting that severe moves were ahead, officials said they still see few signs of inflation abating, which we'll challenge here in a moment. However, some committee members expressed concerns about the risks to the financial system should the Fed continue to press forward at the same aggressive pace. So again, they're starting to get concerned, and I want you to note this, that hey, maybe we've done too much, maybe we've gone too far, maybe there's some risk building in the financial system that we can't see, and we better dial this back. But let's take a look at inflation, because the Fed can't see that inflation is actually going to come down. We look at this chart of the consumer price index in blue on a year-over-year rate of change against U.S. regular all formations gas price in red, it also on a year-over-year rate of change. And look at the very strong relationship between these two, and you can see that gas prices here are going to lead broad inflation lower. And you'll note here that we've seen gas prices, at least on a year-over-year rate of change, stay fairly elevated even though the CPI went higher. And as we've discussed on other shows, there's some other mitigating factors considering, as we've looked at, of rents. And we note that gas prices are coming down near that zero bound. They're not there yet on a year-over-year rate of change, and that's going to bring inflation down. But the Fed officials, well, they can't see that. A substantial majority of participants judge that a slowing in the pace of increase would likely soon be appropriate. The uncertain lags and magnitudes associated with the effects of monetary policy actions on economic activity, keywords, and inflation were among the reasons cited regarding why such an assessment was important. And now what you want you to take away from this so far is they are completely clueless. They do not actually understand the effects that their rate hikes are going to have on the economy and inflation. And let's go back and look at this again, because I want you to see this is their writing. The uncertain lags and magnitudes associated with the effects, there it is, of rate hikes on economic activity and inflation were among the reasons cited regarding why they should slow their pace. Again, they have no clue, and that's the beauty of it. They want to dial this back because internally we're starting to see some members start to go away from Powell's aggressive signals here, and that's causing problems, and they need to get this under control, because if there's something brewing, they're going to be back into zero faster than they've ever been in history. The summary noted that few members indicated that a slowing pace of increase could reduce the risk of instability in the financial system. Although they don't know that it can, they're hoping. Others said they'd like to wait and ease up on the pace, while officials said they see the balance of risk on the economy now skewed to the downside. The Fed has been the target lately of some criticism, you'd think, that it could be tightening too much. The worry is that policymakers are too focused on backward-looking data and missing the signs of inflation that is ebbing and growth is slowing, exactly what we pointed out just a moment ago. And there's other signs the Fed has got this wrong. Let's take a look at the unemployment or the initial claims data from this last week. And here we can note that 240,000 initial claims. Now remember, we were right near that low 200,000, suggesting that the economy was doing great. But look at continuing claims. They're sitting up here at 1.55 million, up 50,000. So we're seeing, despite all these job openings, people are not coming back into the labor force as fast as they should, and initial claims are starting to break out. Now we can look at this chart of the 4-week moving average of initial claims in blue against the federal funds rate, and that we know that when the Fed starts to get too high in the rate, we notice that initial claims start to increase, and we're seeing that now. The problem is, my friends, is that once the initial claim starts to move higher, it generally doesn't slow. Now, we talked about how it rose, it pulled back, and if it took another move higher, that was game over for initial claims, suggesting that even as we're into the holiday season and there's all this demand for labor, that we're going to see more people lose their job, and it all has to do with the Fed. The Fed's aggressive rate hikes are a game changer as monetary policy acts with long lags. The Nobel Prize-winning economist Milton Friedman has famously argued that monetary actions affect economic conditions only after a lag that is both long and variable. And according to Milton Friedman's research, it's a 6 to 12-month range. Well, we're over the 6-month mark, and in March, we hit the 12-month mark, so we know that these lags are going to kick in somewhere. Maybe not yet, maybe it'll be after March, maybe it will just happen that month, but what we know is they're going to kick in, and the problem is we've seen some very aggressive Fed hiking. Since it can take years before the full effects of tightening become apparent, the Fed tends to move incrementally or slowly, adjusting policy gradually while scrutinizing economic data for signs of its effects. But not this time. The Fed this year has been raising rates at the fastest pace in 4 decades. As Chairman Jerome Powell said, this pace is appropriate given the persistence and strength in inflation and the low level from which it started, again making the case that they are absolutely clueless. But the bond market's been telling them, and Powell doesn't want to admit it, that actually he's gone way too far. As Powell's favored curve calls time on the Fed's tightening cycle, the part of the yield curve that the Federal Reserve Chair Jerome Powell watches closely to monitor recession risk inverted for the first time since the pandemic hit in early 2020. The so-called near-term forward spread, which tracks the difference between expected yields on 3-month T-bills in 18 months and those on current T-bills, fell to minus 14 basis points on Thursday. Powell argued that an inversion in the measure means the Fed's going to cut, which means the economy is weak, when he brought investors' attention to it earlier this year. It has now joined other parts of the yield curve, which we've talked about on this show, such as the 3-month 10-year that have turned upside down, which typically show expectations that economic growth is poised to halt. And just how bad is that going to be? Well, let's take a look at these last 2 charts, because I think we'll notice that, of course, not only is inflation coming down, but unemployment is going up as a lot of people are about to lose their jobs. Here we have the 10-year constant maturity minus 3-month in blue, notably inverted when it's below the black line, and now steeply inverted, more so since the actual dot-com bubble. We have the consumer price index in red, and here we can see at points where we're inverted, it usually starts to signal near-term or peak inflation, and that inflation is going to start to come down, right on track with what the yield curve is telling us. How about that 4-week moving average initial claims? Well, we can note that when the curve is inverted and those 4-week moving average of claims should start to be rising here. And if the curve starts to steepen or rates fall, it's game over for the labor market, meaning there's going to be an acceleration of job losses. So now you can see why there's problems inside the Fed. They're looking at the fact that there could be a financial crisis when they should realize there is going to be one, because when millions of people are out of work and can't pay on their loans, that's going to cause a massive problem. And you're seeing it now. Inflation's coming down and job losses are going up. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.